Mike, how was Leesport? You get 2 feet of snow?
Close to it.
Wow, that's a lot.
Yeah, it's I got about 17, I think.
You got a
17
snow
only.
blower?
I did. It doesn't really help much towards the end of the driveway. I get plowed in, so
Yeah.
that was interesting.
Yeah. I cleared mine twice.
Yeah,
And
I did twice. Yeah.
just because I didn't want it to ice over.
See, at this point here, it's just like a daily thing. Sweeping the steps.
No, no, it's been a brutal winter here.
It's so true.
It's uh,
Charlotte, I don't know if you follow American football, but Iowa gave us one of our best defensive backs here in Philadelphia for the Eagles, Cooper
Oh,
DeJean.
really?
Yeah, he's a,
I
he's he's an Iowa University of Iowa graduate.
okay.
So
I don't watch it myself, but I have my best friend is a diehard Eagles fan, so so I'm sure she's pretty happy about that.
gotcha.
Yeah, well, we are now live. We still have a few minutes to go here before the session begins, but I see a couple of people have popped into the waiting room just a few minutes early, so I want to pop in and say hello, welcome. I do have the Xperity team here with me in the Zoom room, and we will begin on time at 11:50 a.m. Eastern time. Thank you all so much for your patience. Now, if you are tuning in live and you're looking for something to do while you wait, feel free to scroll on down to Xperity Ventures virtual booth. It is below the video player. They do have some downloads for you to check out if you're interested. And of course, as always, you can reach out to their team if you have questions. Hello again. Welcome to those who are just joining us. This is your Money Show host speaking. Just letting you know the next session will begin on time in a couple of minutes now at 11:50 a.m. Eastern Time. Thank you for your patience. Hello, everyone, and welcome to the session. I am joined here by Xperity Ventures team. I have Ken Bonenberger, the General Counsel and Chief Risk Officer, Andrew Zuck, Senior Vice President, and Michael Shaw, Chief Financial Officer, here with me in the Zoom room now. Now, to our live viewers, if you have questions for this team during the live session, please feel free to share them in the chat box. It's to the right-hand side of the video player. And with that all said, gentlemen, I will hand the mic and the screen over to you. I'll be here if you need me, but the floor is all yours.
Thank you, Charlotte. Good morning. I'm Andrew Zook, Senior Vice President of Investments at Xperity Ventures. Our elite group of companies specializes in a unique business. We provide non-recourse pre-settlement cash advances to plaintiffs in personal injury lawsuits. The recipients of our advances use our capital for living expenses, which affords their attorneys the time necessary to settle their cases for their maximum value. I assure you, maximum value is not what the aggrieving party's insurance company makes in an initial offer. Litigation finance is a lucrative, recession-proof, and fast-growing asset class. So if you're here today because you're looking for an alternative investment to provide you with consistently great returns, regardless of the economy, regardless of the stock market, regardless of what's going on with the rest of your investment portfolio, our non-correlated investment is a hard-to-beat combination of high yield, lower risk profile, and Ken's going to detail more about that later today, and consistent investor payments since our company's inception in 2009. Every dollar of investor capital has been returned in full and on time, as have all interest payments. I have a lot of experience in alternative investments. A company with a payment history like ours is unique. Why are we such reliable payers? Consider the Xperity business model. On average, we advance $1 to a plaintiff in a personal injury lawsuit. For that dollar, we get a lien against the case that's payable from the attorney's trust account. For every dollar that we advance, on average, we receive back $1.51 in 18 months or less. Our historical loss rate is 3.3% of advanced capital. So we enjoy impressive margins in a business that's virtually recession-proof. Let's see here. Charlotte, is my screen sharing presently?
Not just yet. Let's give it
Give me
another
one
try here.
Give me 1 second. Let's share here.
All right.
How's that?
Okay, I see the full screen now.
Outstanding.
Beautiful.
There we go. So this slide here is going to give you a few details about our investment before I turn it over to Mike and Ken. And I want you to know how you can get in contact with us. So I'll have this slide up again at the end of the webinar. Our alternative investment offering is paying a 12% yield. We make quarterly distributions. This is for accredited investors only. We have a 506C offering. The minimum investment is $50,000. If you like what you hear in our presentation today, you can scan this QR code here on slide 1. And again, I'll have it up during the Q&A session that we'll moderate. You can scan this, and this will take you directly to my calendar. We can schedule some brief discussion time to ask me your questions or talk further about this. The cell phone number on your screen is my direct number. You can call or text it. That number is 610-220-3459. Or you can email me at azook@xperityventures.com. Now our CFO, Michael Shaw, is going to share a little bit about his background before he hands the ball off to Ken.
Thank you, Andy, and good afternoon, everybody. My name is Michael Shaw. I'm the CFO of Xperity Venture and all its subsidiaries. I've been the CFO of Xperity since 2018. Prior to that, I was a Chief Accounting Officer of the J.G. Wentworth Company. Prior to that, I was heading an M&A transaction and advisory team for Santander Bank here in the U.S. Started my career as an auditor for Ernst & Young. I'm both CPA and an attorney. Just adding a couple of things about our performance. We're not a new company. We've been around since 2009. The holding company Xperity was set up in 2019, and we were named in the Inc. 5000 3 years in a row at the top 15% growing company in the US. Last year, the 2025 year, our EBITDA was $86.3 million, and we deployed more than $211 million to our clients. Like Andy said, for every dollar deployed, we get $1.50 in approximately 18 months. We're extremely profitable company, and what we're seeking is additional capital to supplement our existing warehouse line that we have here in the US. We currently have four different warehouse lines in the US with a total of about $635 million. And we are looking to raise additional capital to help us get to 100% advance rates until we meet our objectives of being the number one company here in the US. I'm going to turn over to Ken Bonenberger, who is our Chief Risk Officer of the company.
Thanks, Mike. Good morning, folks, or almost good afternoon. Yes, my name is Ken Bonenberger. I've been in the specialty finance space since 2008. Initially got started with Peachtree Funding, which merged with J.G. Wentworth, two pretty prominent names you may have heard of in this space. And then 2016, I came on board with Thrivest and have been there since then. I got my undergraduate degree in economics from Haverford College and my law degree from the University of Florida Law School. This gives you a little bit of our company snapshot, primarily what we do. The two items you see in bold at the top, pre-settlement funding and medical funding. Pre-settlement funding is given to the plaintiffs who are involved in a personal injury lawsuit. And then medical funding is funding that is provided to doctors, healthcare providers who provide treatment to those plaintiffs who have a personal injury lawsuit. Our team currently, our sales team is currently made up of about 13 sales folks who have been in the space for quite some time. Those are the internal sales folks. We also have a program with joint ventures, which is primary relationships with smaller funding companies who don't have the investment grade pedigree that we do, and they need access to capital. So we vet them and bring them on, and everything is white labeled. It appears on their paper, but everything flows through us. We do all the funding, we do all the collecting. We currently have about 2,000 plus attorneys in our database that we've done business with over the years, and that's across the United States. And in terms of the rest of the employee base, we have about 50 plus employees, full-time employees, with offices in Conshohocken, Pennsylvania, which is just outside of Philadelphia, New York City, Las Vegas, and Boca Raton, Florida. This slide here gives you a little overview of the pre-settlement advance transactions that we engage in. Again, the individuals are involved in personal injury cases. As a result of their personal injuries, they often are out of work or unemployed, underemployed, and they need funding to pay for bills, pay for rent, pay for medical treatment, and to help them get through the litigation life cycle while their attorney litigates the case. And as Andy noted, being able to provide them the funding allows them to not have to take a lowball offer from the insurance company. So instead of taking a $10,000, what we'd call a nuisance value offer for their case, the attorney can now litigate it fully and potentially get six figures or more, depending on the injuries, etc. But that's the idea, is that we provide a lifeline to them that allows them to see the case for its full value. And again, these folks are coming to us because these aren't loans. Frequently, these are non-recourse advances, which means if they lose the case, then we don't get repaid. So they come to us because they don't have the credit history to get a traditional bank loan. So given the fact that they're non-recourse, we vet those cases, make sure it's a good case before we give them the funding. And as you can see from our investment method, the way we underwrite a case is we run it through our algorithm. Each individual underwriter vets the case, goes through all the documentation, derives a value, which is frequently we usually gauge it as a value less than what the attorney would value it at, just to be conservative, just to give us a buffer, just in case, the value is off slightly. Now, once we derive that value, we can then advance the plaintiff 10 to 15% generally maximum of what that value is. So, for instance, if we value the case at $100,000, we can fund them $10,000 to $15,000. Again, the investment structure and flow of funds, as I noted, these aren't loans. The contracts are a purchase and sale assignment. So the plaintiff who's involved in the case is effectively assigning us a portion of their potential future proceeds when the case settles. Like I said, they're non-recourse, so if they lose, we don't get repaid. Um, and it's a standard contract that the plaintiff signs, and then the attorney acknowledges that lien, which triggers professional obligations on their part, rules of ethics, rules of the bar for their applicable state. They have an obligation to protect the property of third parties. And then, yeah, here, this shows you a little bit about our performance history. As Andy noted in the intro, we have an historical loss rate of only 3.3% of principal deployed, which is, tops amongst the industry. Many other funding companies, their loss rates are 7%, 10, even some size 10%. So we do a really good job of vetting these cases. On the left-hand side there, under data analytics and drive underwriting model, uh, as I mentioned, we have a very advanced algorithm. All the underwriters are well versed in it. They know how to, look a personal injury case up, down, from all angles and make sure it's a good case before we invest. We also perform background checks on the plaintiffs, on the attorney, on the law firm, make sure that, the attorneys are properly barred in the applicable state. There's no untoward disciplinary history. Uh, the plaintiff similarly making sure that there's no open bankruptcies, child support liens, tax liens, things that would potentially be a priority over our lien. And we also have, we've been in this space since 2009. So the attorney analytics that we have a wealth of information about the attorneys we've worked with. And, it tells us what their MOIC is. It tells us essentially what their win-loss rate is. So we can, in addition to vetting individual cases, we can look at the law firm itself, look at the attorney himself or herself, and determine, okay, is this a good attorney? Or, not only is it a good case, but are we also working with a good attorney? Here we have the single unit economics for both the pre-settlement funding and for the medical receivable funding. Average advance per claim for a plaintiff is about $5,000, just over. And then like I said, we can fund up to 10 to 15% of whatever the projected value is. But historically, we've only really funded 6.3% of whatever that expected value is. So not only are we conservative in our valuations, but historically, we've also been conservative in how much money we give them. So again, there's a lot of buffer there, in case the values come in slightly lower than we anticipated. And on the pre-settlement side, as Andy noted, company-wide, when we advance a dollar, we get back about 1.51. Pre-settlement side, we advance a dollar, we get back about $1.40. Similarly, on the medical receivable side, for every dollar we advance, we get back about $1.60. So again, these are very lucrative investment models.
All right, and I'm just going to get back to our investment offering. Thank you, Ken. I'm going to remind everybody that all alternative investments are a combination of yield and risk. So as I remind you that our investment is going to consistently pay you a 12% return and distributed quarterly, I will also acknowledge that there are many alternative investments out there offering higher initial yields for you to get involved. What does that often mean? That often means that higher yield is being offered is to compensate for the higher risk that is inherent in said investment, and that yield needs to be offered to attract the capital that that firm needs. There are also firms that rely on accredited investor note investments like this for their entire capital stack. Thus, they've got to offer really lucrative returns because that they're not institutional grade, unlike Xperity, and they can't attract $600+ million in senior warehouse facilities. So it's important to note when you're partnering with the GP that you're confident that you're going to get repaid. Those international banks wouldn't provide us with lines of credit to that degree if they didn't audit us regularly and believe in our financial strength and profitability. So in closing, again, we've got an investment offering. It's an evergreen. We're accepting capital. We're paying 12%. It is a standard interval fund investment. So the duration of the note is 5 years. With this, you get the best of both worlds. That 12% yield will be fixed for the duration of your 5-year investment term. You do get liquidity options beginning after 1 year in the investment. Those liquidity options are detailed in writing on pages 7 and 8 of the private placement memorandum that I forward to every prospective investor and point those out to you. Similarly, we have audited financial statements for every year of operation. We're audited by a US-based audit firm each year. We make those available to investors during their due diligence process. An educated investor is my best friend. So with that, Charlotte, I'm going to close our presentation and open the floor up to questions if you'd like.
Beautiful, Andrew. Thank you. All right. Well, I do have a couple of questions that have been sent in here, but to anyone else who is sitting around waiting, if you're curious, feel free to go ahead and send your questions in the live chat box on the right-hand side of the video player. Now, just to get started here, Andrew, I'll begin with this question that was sent in to me by Jay. It appears you enjoy a high interest rate on the money you advance. Is there any risk that the government will step in and regulate how much you can charge? If so, how does that impact your investors?
I can take that one, Andy. Yeah, with respect to the regulatory landscape for the industry, currently most states are unregulated, meaning that the law that governs these transactions is dictated by case law. And that essentially means whether or not a plaintiff can assign any potential proceeds from their personal injury case. And for most of the country, that's the case. There are a handful of states that do have legislation that has been passed. And to be fair, we're in favor of legislation. We think it's a good thing. Most recently, this past year, Georgia, California, and New York just passed legislation. So those are three of the bigger states that we work in. And what they've done is put in rates. Some of them don't even put in rate caps because again, these aren't loans. So we're not subject to usury. There's a risk here. We're on the same side of the table as the attorneys and the plaintiff. So if the attorney doesn't win the case for the plaintiff and they don't get any money or they get less than they anticipated, then we lose out. So there is no absolute obligation to repay anything, which is why we're not subject to usury. But the statutes that have been put into place, to the extent that they have put in a rate cap, it's usually been at that military lending rate, which is 36% APR, which is, again, that's a fantastic rate. As long as the legislation that gets passed is in that ballpark, then it's fine for us. And it also, like I said, we're in favor of it because it also requires companies to get registered, licensed frequently. it requires them to go through a vetting process to put up a bond to show that they have the financial wherewithal to operate as a business in good standing. And it also would weed out some bad actors within the industry, the smaller players who are really trying to prey on people. They would be shut out. So again, that's why we're in favor of it. And we belong to a trade organization called Alpha, American Legal Finance Association. And it's a conglomeration of other funding companies like ourselves who get together, share best practices, and also have lobbyists who, anytime there's legislation that potentially pops up, we're working with the legislators in those respective states. We're proposing good bills that can get passed that were beneficial to not only do they protect the consumer, but they make the business viable and give assurances that the companies who are doing business in those states are on the up and up. So I hope that answers the question.
Fantastic. Thank you. We did get another question in here from Mr. Castleman. He's asking, what are the best ways to do due diligence on your firm if this is a new niche to the investor? Thank you in advance.
Due
To do due
diligence.
diligence on Xperity. I mean, the best way to do due diligence on Xperity is obviously look at our audited financial statement. We've been audited for, I don't know, 8, 9 years by now, right? Even I'm happy to put you in touch with our banks that will vouch for us, right? No, nobody's going to give us $635 million, unless they believe in the management team and believe in the integrity of the company. So feel free to give me a call after this, and I'm happy to put you in touch with any of our investors. So,
thank you, Mike. And another question I have here from Joe E is, does this generate a 1099 or K1? And how are returns typically characterized? Is this ordinary income or gains?
I can tackle that, Andy. It will be a 1099 interest.
I should note though, Charlotte, that 50% of my investors invest with qualified money. If you want to do that, you just need to use a self-directed IRA custodian, which many of the listeners are familiar with. So if you don't want to trigger a 1099 at the end of the year, you can fall into the category of my investors. Just use their IRA to make the investment.
Fantastic. Thank you. All right, moving along, as we do have another question from Mr. Castleman. He's asking, how soon after investing would the investor begin to receive interest?
So distributions are made on 4 set dates each year. As we've grown, this makes life a little bit easier on our accounting team. So distributions are made mid-January, mid-April, mid-July, and mid-October. So I'll give you an example. We'll be closing up. We aggregate notes on the 15th and 30th of each month. So we'll be closing this week our note investment for January 30th. Those investors will be in the investment for 2/3 of Q1. So say they invested 100 grand, they would earn $12,000 a year in interest, which would be an interest payment of $3,000 each quarter. For those investors in our January 30th note, their first interest payment will be prorated because they're going to be in the investment for 2/3 of Q1. So their interest payment in mid-April would only be $2,000. Each subsequent quarter, they would earn the $3,000 interest.
Thank you. And I apologize if you've touched on this next one at all, but I have another question here saying you've mentioned that your loss rate is less than 4%. I assume that it's low. What do you attribute that to, and how do you compare to other competitors in your space?
Sure. Yeah, chalk it up to our underwriting. We have a team of about, I want to say it's about 10 people at this point who have years of experience either working for a law firm, they're attorneys themselves, or they were adjusters for insurance companies. So they've been on the other side. They've been on that defense side. They understand how insurance companies look at cases, value cases. And we have a very good algorithm that the underwriters follow. As I mentioned, we largely an attorney, plaintiffs' attorneys are often very ambitious, very much a go-getter type A's, which is good because they get results. But they also sometimes can elevate the settlement value that they think the case will ultimately settle for. So we generally value it under that. We're conservative in our estimates of values. That way, just in case something, the case doesn't say, let's say instead of settling for $100,000, it ultimately settles for 75. There's still a buffer there for us to collect the money that we deployed plus the accretion. And again, we're only funding maximum 10 to 15% of projected value. And historically, we've not even, that's the upper limit of what we generally do. But historically, year over year, we've only actually funded 6+ % of projected value. So there's a lot of this combination of conservative valuation, the buffers building in terms of the maximum amount that we can fund to the plaintiffs, and even undercutting that amount by a large degree. So that's, the primary reason for our success. Also, we're dealing, like I said, we have been in business since 2009, and we have a lot of metrics and data on law firms, on attorneys in terms of how they've performed when we funded their clients. So we certainly can lean on that a lot in terms of, betting, situation of betting on the jockey, not the horse necessarily. So if you're dealing with a pedigree law firm who gets results, you're more likely than not gonna have a successful result for your investment. Um, and in terms of the industry standard, I think I touched on it. I think the industry standard is between 7 and 10%. There's certainly funders out there who are got a loss ratio of 10% of their principal deployed. Um, so we're up amongst the best in the industry with our 3.3% loss rate.
All right. I think we have time for at least one more question here. This one's from Mr. Fitz asking, what happens if the cases I invest in do not turn out to be winners?
Well, you're not investing in any one or collective of cases. Your risk is spread across the entire company. Um, so it's whether or not any one individual case performs or doesn't perform isn't going to dictate, how your investment does. So you have a Mike, I don't even know how many cases we have in our system, but
Okay. Yeah, we have more than 10,000 cases. I mean, literally, for you to lose a dollar, we have to lose $80 million in equity before there is an exposure for $1 of from an investor, right? So it's not tied to any specific case, but we really gonna have to lose like 80-90% of our portfolio in order for investors to lose money. So yeah, and don't forget your capital is a small percentage that goes side by side, the bank, right? So we're not using 100% of your capital to advance against a case. We're using a very small percentage of that. So
Thank you all. And it looks like we do have time for this last question I have for you. It's a bit of a long one. It says, for an accredited investor looking at private credit in litigation finance, how should we think about the main risk drivers in your portfolio? And what has your realized loss experience looked like over different market cycles?
yeah, that's a good question. I can take that. So very good question. And so when you're looking at our portfolio, first of all, we are well diversified. And what I mean well diversified is that we have, thousands of law firms that we deal with, okay, across 10 plus thousands of cases, okay. So that's a well diversified portfolio. In addition, we don't have a significant concentration in any given state. Just in case there's some regulatory issues in one state, we don't have more than 30% concentration in one state. New York being the biggest one, of course, But we have a lot of assets in Florida, and we have in Georgia, and California, and so on and so forth. Okay. In addition, not only that the cases are being diversified across law firms and plaintiff, we also had different types of cases, and the majority of them are motor vehicle accident. Those are all single action and single event, right? So it's not like it's a mass tort that, you're putting all the eggs in one basket and you have one outcome, right? So that is how you should really look at it. So we're well diversified from an attorney perspective, client perspective, case perspective, and state perspective.
Well, Andrew, Ken, Michael, thank you all so much for joining us today. Thanks so much as well for getting some of those questions answered. I know our audience definitely appreciates it. Fantastic session with all three of you, and look forward to seeing you in the future.
Thank you, Charlotte.
Thanks, Charlotte.
Absolutely. And to those of you watching live, thank you as well for joining us. And be sure to stay tuned, as we have a lot more in store for you in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.
Thank you. Bye.